The very thing you believe is making you wealthy might actually be your biggest financial trap. We've been told that index funds are the ultimate safety net, diversified, passive, and secure. But right now, millions of portfolios are resting on a structural illusion that mirrors the 1600s Tulip Mania and the 1970s Nifty Fifty crash. In the early 1600s, Dutch merchants became obsessed with tulip bulbs, not for their use, but because the price only went up. A single bulb eventually cost more than a house. Then, almost overnight, fortunes vanished. In the 1970s, Wall Street claimed there were 50 stocks so dominant you could buy them at any price and hold forever. When that story broke, it took investors 25 years just to break even, not to make a profit, just to get back to zero. Fast forward to today, your retirement account is likely repeating this exact historical mistake, just with a different asset. My name is AR, and I study market patterns, valuation cycles, and how wealth is actually built or destroyed over decades. Traditional investing advice sounds perfect in a bull market, but it rarely addresses the structural architecture that causes catastrophic losses when the economic environment shifts. By the end of this video, you'll understand a specific structural issue affecting millions of portfolios right now, why it echoes the greatest financial crises in history, and the specific framework successful long-term investors use to protect themselves. This isn't about predicting a crash, it's about knowing if the house you're building is resting on a foundation that can survive a storm. Let's start with a single question. Do you know what percentage of your entire investment portfolio is concentrated in just 7 companies? If you don't know the answer, you aren't just investing, you're standing in the middle of a pattern you don't see coming. Let's look at the data. Before we talk about your portfolio, let me tell you about something that happened in the 1970s that changed how an entire generation thought about investing.
There was a group of 50 stocks that Wall Street called the Nifty 50. These were companies like Kodak, Polaroid, Xerox, Sears, and Avon. The idea was simple. These companies were so dominant, so essential to American life, that you could buy them at any price and hold forever. Growth was guaranteed. Institutional investors, the smart money, poured billions into these 50 names. The stocks traded at extreme valuations, sometimes 60 or 80 times their annual earnings. But everyone said it didn't matter because these companies would grow into their valuations. Then the economic environment shifted. Oil prices spiked. Inflation rose. A recession hit. Suddenly, the growth story broke. Polaroid fell over 90% from its peak. Avon dropped more than 85%. Xerox lost over 70% of its value. These weren't risky startups. They were considered the safest investments in America. Here's what's important. If you bought at the peak in 1972, some of these stocks took 25 years just to break even, not to make money, just to get back to where you started. That's a quarter century of zero returns on what everyone called safe investments. So what went wrong? First, investors decided that a small group of stocks were so good that price didn't matter. Second, that belief drove prices higher, creating a feedback loop. Third, when conditions changed, the most expensive stocks had the furthest to fall. Fourth, the diversification everyone thought they had disappeared because all the safe stocks crashed together. Now here's the part that matters for you today. The financial structure that created the Nifty 50 crash didn't disappear, it just evolved. Let me show you what's happening in portfolios right now and why it echoes this historical pattern. If you own a standard index fund, something tracking the S&P 500 or a total market fund, here's what you probably don't realize. As of 2026, roughly 30% of that fund's value is concentrated in approximately 7 companies, 7 out of 500. These are Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla. Incredible companies with real businesses, real profits, and genuine innovation. I'm not questioning their quality. But here's the structural issue. If you think you're diversified because you own 500 companies, you're not looking at how the weighting actually works. Imagine building a house. The contractor tells you they're using 500 support beams. Sounds incredibly strong, right? Then you discover that 70% of the weight of your entire house, the foundation, the walls, the roof, rests on just 7 of those beams. Those 7 beams are currently very strong. They've been getting stronger for years. But would you feel comfortable living in that house? Would you raise your family there? That's the architecture of most index funds right now. This concentration isn't normal historically. In the 1990s, the top 7 companies in the S&P 500 represented about 15% of the index. We've essentially doubled the concentration in 25 years. Now you might think, but AR, those companies are massive and profitable. They deserve to be worth more. That's true, but the Nifty 50 were also profitable. Tulip traders in 1637 also had reasons that sounded logical at the time. The question isn't whether these companies are good. The question is whether you understand the structural bet you're making. Let me explain why concentration matters more than most people realize. When you buy a market cap-weighted index fund, you're not buying equal pieces of 500 companies. You're automatically putting more money into whatever has already gone up the most. It's a system that buys more of what's expensive and less of what's cheap. Think about that for a moment. Every dollar you add to a standard index fund automatically flows disproportionately to the stocks that have already risen the most. That's the opposite of what successful investors actually do. Let's make this concrete with a simple scenario. Suppose you have $500,000 in a standard S&P 500 fund. Based on current weightings, approximately $150,000 of that is in 7 technology companies. If those 7 stocks decline by 50%, which has happened to high-flying stocks before, in 2000 to 2002 and with the Nifty 50, you lose $75,000 just from that concentration. Even if the other 493 companies stay completely flat, you're down 15% overall. That's not a prediction. It's just math showing what your exposure actually is. Now, here's the question you need to ask yourself. Are you aware of this concentration? Did you choose it intentionally, or did it happen automatically because of how index funds are structured? For most people, the answer is that it happened automatically. They bought an index fund thinking diversification equals safety, without understanding that diversification and concentration can exist in the same portfolio. There's a psychological aspect to this that's equally important. When market conditions are good and everything's rising, concentrated positions feel great. You're making money. Your account balance goes up. It feels like you're doing the right thing. But this is exactly when risk builds quietly in the background. The challenge is that when concentration works, it works really well. And when it doesn't work, it fails catastrophically. There's no middle ground. Let me give you a framework for thinking about this differently. Wealth isn't built by hitting home runs every year. It's built by avoiding strikeouts, by staying in the game long enough to benefit from compounding. If you can generate reasonable returns, let's say 7 to 9% annually, and avoid catastrophic losses, you'll outperform the vast majority of investors over 30 years. The people who chase 15% returns every year are often the same people who blow up when conditions change. This is why understanding your actual exposure matters more than chasing performance. Here's a scenario to make this real. Imagine it's late 2027. Something happens, a recession, geopolitical event, regulatory change, whatever. The mega-cap tech stocks drop 40% in 6 months. The S&P 500 drops 28% overall. Your colleague who's planning to retire in 2028 and has everything in a standard index fund watches their portfolio go from $900,000 to $650,000. They panic. They feel like a victim of circumstances beyond their control. They might sell at the bottom, locking in losses. But someone who understood their concentration risk and took steps to address it earlier might experience a 20% decline instead of 28%. Not fun, but not catastrophic. And because they have cash reserves, they don't need to sell. They might even buy more at lower prices. Same market event, completely different outcomes. The difference is preparation and awareness. So what does thoughtful portfolio construction actually look like when you understand concentration risk? Let me share a framework, not as advice, but as an educational example of how some successful long-term investors think about this.
First principle, check your actual exposure, not what you think you're exposed to. Most index funds publish their holdings. You can see exactly what percentage is in the top 10 companies. If it's more than 25%, you have concentration risk whether you realize it or not.
This takes 5 minutes. Go look tonight. Second principle, understand that market cap weighting automatically concentrates risk in whatever has already risen the most. You can counter this with strategies like equal weight funds, where each company gets the same allocation regardless of size. Or you can look at international markets, which are currently trading at much lower valuations than US stocks, or small and mid-cap value stocks, which have historically outperformed large-cap growth over very long periods. I'm not saying these alternatives are better, I'm saying they're different, and different means they don't all move together. Third principle, build what I call valuation discipline into your approach. This means setting rules ahead of time that remove emotion from decisions. For example, if any single holding becomes more than 8% of your portfolio, rebalance it back to 8%. If the market reaches extreme valuations by historical standards, shift some allocation to bonds or cash. These aren't market timing strategies, they're risk management frameworks. Fourth principle, create an income floor outside your portfolio. The reason people panic sell during crashes is simple. They need money and have no other options. If you have 12 months of expenses and accessible savings, you can wait out volatility without being forced to sell at the bottom. During 2008, people with cash reserves bought stocks at massive discounts. People without cash reserves sold at massive discounts to pay bills. Same event, opposite outcomes, entirely based on liquidity. Fifth principle, be honest about time horizon. The advice to buy and hold for 30 years is excellent if you're 25. If you're 50 and planning to retire at 65, you have 15 years. If a major market decline happens in year 10, you don't have time to fully recover. The sequence of returns matters as much as the average return. Two people can get identical average annual returns over 20 years, but if one experiences a crash right before retirement and the other early in their career, the first person might run out of money while the second is fine. Let me give you one more historical example that illustrates why assuming the market always recovers isn't a complete strategy. In 1989, Japan's stock market was the largest in the world. Japanese companies were buying real estate globally. Everyone said Japan would overtake the United States economically. Japanese stocks traded at 60 times earnings because growth seemed inevitable. If you were a Japanese investor in 1989 and you bought a Japanese index fund and held, you lost 75% over the next 3 years. The market bottomed in 2003. As of 2026, 37 years later, it only recently returned to the 1989 peak. 37 years of zero real returns in what was considered the world's best market. Now, Japan had specific structural challenges, but the point is that the market always comes back is only true if you're talking about global markets over a century. Specific markets can stay down for decades. Even in the United States, which has been the best performing market globally, there have been long stretches of flat returns. 1966 to 1982, basically flat after inflation. 2000 to 2012, flat. If you needed money during those periods, you were in trouble. The lesson isn't don't invest. The lesson is don't assume what worked for the last 15 years will work for the next 15. So what would a thoughtfully constructed portfolio look like in 2026 for someone who understands these principles? Again, this isn't financial advice. It's an educational framework showing how some institutional investors think about diversification. You might have 30% in diversified US stocks, but using equal weight or tilting towards smaller companies that aren't as expensive. Another 20% in international developed markets, places like Europe, Japan, Australia, that are trading at lower valuations than US markets. Perhaps 10% in emerging markets for long-term growth exposure. Then 15% in real assets, real estate investment trusts that own actual property, commodities, infrastructure, things that tend to perform differently than stocks. another 15% in bonds for stability, mixing treasuries for safety with corporate bonds for income, and 10% in cash or equivalents for emergencies and opportunities. Notice what this does. No single position dominates. If technology crashes, you're not destroyed. If inflation rises, you have some protection. If interest rates increase, you have cash to redeploy. You're not trying to predict what happens next. You're trying to build something that survives different versions of the future. Would this outperform a concentrated S&P 500 fund if the current trends continue? Probably not. You'd give up some upside. But if concentration reverses and those 7 stocks decline significantly, you'd protect far more wealth. You're trading maximum gains for lower losses. And at a certain point, that's the right trade. When you're trying to build your first $100,000, taking more risk makes sense. When you're protecting $500,000 or more, not losing it becomes more important than doubling it. Here's the fundamental shift in thinking that needs to happen. Most people treat their portfolio like a plant. Add money regularly, leave it alone, hope it grows. That approach worked exceptionally well from 1980 to 2000 and 2009 to 2021 when we had tailwinds of falling interest rates and expanding valuations. But those tailwinds are over. Interest rates are higher. Valuations are already elevated by historical standards. You can't just set and forget anymore. You need to treat your portfolio like a garden. You still plant and water, but you also weed, prune, and adapt to changing seasons. This doesn't mean daily trading or obsessing over headlines. It means quarterly check-ins where you assess valuation, rebalance what's grown too large, trim what's expensive, add to what's cheap. The reason this matters emotionally is that when the next market decline comes, and declines always come eventually, you need to know you prepared. If you just bought a standard fund and hoped, you'll feel like a victim when it drops significantly. You might panic and sell at the bottom. But if you've already addressed concentration, built cash reserves, and diversified thoughtfully, you'll feel like you prepared. You won't be happy about temporary losses, but you won't be destroyed. You'll be able to hold steady or even add to positions when they're cheaper. That's the difference between building wealth through cycles and getting wrecked by them. Let me bring this together. Wealth building isn't about finding secret strategies or timing markets perfectly. It's about understanding the actual structure of your portfolio, recognizing where risk is concentrated, and making intentional choices rather than accepting defaults. The financial industry has made investing seem either impossibly complex or mindlessly simple. The truth is in the middle. You don't need to be an expert, but you do need to be engaged. If I were approaching investing in 2026, here's what I'd focus on. Understanding my actual exposure by checking my holdings, not assuming. Recognizing that what worked in the past decade might not work in the next. Building diversification across different assets and geographies, not just different company names. Creating cash reserves so I'm never forced to sell at the worst time. Setting up rules to rebalance automatically, removing emotion from decisions, and accepting that I might underperform in bull markets in exchange for better protection in difficult markets. This isn't exciting. It won't make you rich overnight, but it's based on how markets actually work over long periods and how successful institutional investors think about risk. Most people won't do this because it requires effort and awareness. But if you've watched this far, you're not most people. You're someone who wants to understand how this works rather than just following conventional wisdom. So here's what I'd encourage you to do tonight. Open your investment account. Look at your actual holdings. See what percentage is in the top 10 companies. Just know what you actually own. That awareness alone puts you ahead of most investors. If you found this educational and want more content on how markets actually work rather than how they're sold to you, subscribe to AR Investor. This type of analysis is what we focus on. Remember, this is education, not advice. Your situation is unique, but understanding these principles helps you make better decisions for yourself. Thanks for watching. I'll see you in the next one.